All right, let's unpack this. Today, we're diving into a pretty specific and honestly sometimes surprising area of investing. We're talking about the tax rules for gold and silver.
Yeah, it's definitely not the same playbook you'd use for, say, stocks or bonds, and I think that's where a lot of the confusion can come in.
Exactly. And our guide for this deep dive, our source material, is an article by Doug Young. He seems to have a really solid background in, well, both financial investing and the precious metals market itself.
Right, and our mission here is, well, pretty simple, really. We want to try and cut through some of that complexity, pull out the absolute must-know points from this article. So,
Hmm.
you can walk away understanding how the IRS actually looks at gold and silver, how profits get taxed, and importantly, what strategies the source mentions for maybe minimizing your tax liability, keeping more of your money.
And believe us, there are some interesting twists here, particularly around why these assets get treated differently by the IRS and what that actually means for your tax bill.
Okay, so let's just jump right in. The core of it, why are gold and silver taxes different? What does Doug Young's article flag right away as the key distinction?
Yeah, right off the bat, the article is super clear. The IRS classifies physical gold and silver as collectibles.
Collectibles. Okay. So not capital assets in the same way as like a share of Apple stock or a corporate bond.
Hmm.
And this classification, it's really the foundation for everything else tax-wise, isn't it?
That's honestly surprising to me. Collectibles. Like, you mean like art or, I don't know, rare stamps? How does that change the way gains are taxed compared to, let's say, selling a stock you've held?
Well, the big impact is on the long-term capital gains rate. I mean, just like other investments, if you sell gold or silver for a profit, that's a capital gain. Simple enough, but the rate you pay depends on how long you held it.
Okay, okay. So same basic idea of long-term versus short-term holding periods, but the actual numbers, the tax rates are different specifically because of this collectible status.
Precisely, yeah. The article specifies that for gold and silver held for more than a year, that's what the IRS counts as long-term for these. The maximum capital gains tax rate is 28%.
Whoa, hang on. 28%. That feels quite a bit higher than the usual maximum long-term rate for stocks, right? Which is about 20% for most people.
It is higher, and that's a really critical point from the source.
Yeah.
That collectible status means your long-term gains could face this higher 28% rate.
Okay, so holding for over a year caps you at 28%. What if you sell faster, like within a year?
Well, if you sell within a year, the article explains those gains are short-term capital gains, and they get taxed at your ordinary income rate. So depending on your total income, that rate could go as high as 37%.
Up to 37%. Okay, wow. So straight away, the holding period isn't just about long versus short. It's about a potentially massive difference in the actual tax rate applied to your profit. The article really seems to emphasize that just holding for that extra day over a year can make a really significant tax difference. Yeah.
Exactly. But, before you even get to worrying about the rate, you need to figure out the actual gain. And that always starts with your cost basis.
Right. And the article spends some time on this because it's not just the price tag on the metal itself when you bought it, is it?
No, not at all. Your cost basis is like your initial investment amount in that specific asset.
Right.
And the source is very clear. It includes more than just the spot price or, the face value of a coin.
Okay, so what else gets included in that basis number? The article had a good example, I think.
Yes, the source explains your cost basis, includes the initial purchase price, plus any other costs you had to pay to actually acquire it. So think about the premium you pay to a dealer, that amount over the melt value or spot price. That premium is part of your cost.
Oh, interesting. So if you bought, say, a gold bar for $1,500, but the dealer charged a $50 premium, your starting point for calculating profit isn't $1,500, it's actually $50.
Exactly right. That $50 premium becomes part of your investment cost. And the article points out other costs you might be able to add to your basis too.
Like storage fees. If you're paying a third-party service to hold the physical metal for you.
Correct, yeah.
Hmm.
If you're paying for secure storage, those annual fees, according to the source, can be added to your cost basis.
Mm.
The article even gives an example, like if you paid $100 a year for storage for 3 years, you could add $300 to your basis when you eventually sell. That reduces your taxable gain even further.
Hmm. That's a really crucial detail. It sounds like keeping meticulous records isn't just, a good habit. It's absolutely essential for calculating your gain accurately and reporting it correctly. The source mentions reporting these sales on Schedule D of Form 1040, right?
Mm,
And it really stresses meeting detailed records, purchase dates, prices, those premiums, storage fees, maybe even costs related to the sale itself.
Absolutely. Having that paper trail, that documentation, helps make sure you're only paying tax on the actual profit you made after all those related costs are factored in, not, some inflated amount. The example in the article about selling a silver coin for $200 with a $150 cost basis, making the gain $50, really shows why tracking that basis is so important.
Okay, okay. So we get the classification collectibles, we get the rates 28% long-term max, ordinary income, short-term, and we know how to figure out the starting point, the cost basis. What does the article say about being proactive, about actually trying to minimize the tax you might owe?
Right. So the source naturally moves from just understanding the rules to um, practical strategies for managing that tax bite.
So I guess we already sort of touched on the first one, didn't we? The holding period strategy.
Exactly. Yeah. Given that potential jump from a 28% max rate up to possibly 37%, just simply holding your gold or silver for more than 365 days is the most direct strategy the article discusses. That qualifies you for the lower long-term collectible rate. It's straightforward, but, well, it requires patience.
Makes sense. And the other strategy mentioned, it sounds familiar from other kinds of investing, tax loss harvesting.
Yes, exactly. The article explains how this technique, which you often hear about with stocks or mutual funds, can apply here too. It basically involves selling an investment, any investment really, that has gone down in value to deliberately realize a loss on paper.
Okay, and how does realizing that loss help specifically with gains from gold and silver?
Well, that realized loss can be used to offset capital gains you've made elsewhere, including gains from selling your gold or silver. So if you have, say, a $1,000 gain from selling some gold, but maybe a $600 loss from selling some stock, the article notes you'd only pay tax on the net gain of $400 in that scenario. It's basically a way to use losses in one part of your portfolio to reduce your overall taxable income from gains in another part. Now, the article also makes a point of highlighting a completely different sort of tax situation. If you decide to hold gold and silver within an IRA,
Ah, right. The IRA route. That offers potential tax advantages, I guess, but it definitely comes with its own specific IRS rulebook. What's the first thing the source points out about putting precious metals into an IRA?
the key constraint right up front is the purity standard. You can't just put any gold or silver coin or bar in there. The article is very specific. Gold must be 99.5% pure, and silver needs to be 99.9% pure to be eligible for a self-directed IRA.
Okay. So things like, specific bars or certain government coins that meet those standards. I think it mentioned American Gold Eagles or Canadian Maple Leafs as examples. So you really have to check that purity requirement carefully before buying for an IRA.
Absolutely critical. And while your contributions generally follow the standard IRA limits, the tax treatment changes quite significantly when you eventually take distributions, when you take the metal or cash out.
Right. The article emphasizes this point. When you withdraw metal or cash from a precious metals IRA, maybe in retirement, those distributions get taxed as ordinary income.
That's correct. So unlike selling metal you held personally, where you might pay that 28% collectible rate on long-term gains, taking it out of an IRA means it just gets added to your regular income for that year, and it's taxed at your marginal rate, which again could be up to 37%. It's a really crucial difference to understand if you're considering using an IRA for holding metals.
Okay, so let's try and pull together the main takeaways here, the key insights from Doug Young's article on this. What are the absolute must-knows for you, the listener?
Okay, number one, I'd say. Gold and silver are classified as collectibles by the IRS. That immediately sets them apart tax-wise from your typical stock and bond investments.
Right, and that collectible classification means different capital gains rates. A maximum of 28% for long-term gains if you hold over a year, which is probably higher than the rate for other assets you hold long-term. And your normal ordinary income rates, potentially up to 37% for any short-term gains if you hold a year or less.
Yeah. And calculating your taxable gain. It's not just sale price minus purchase price. The source makes it really clear. You need to factor in your full cost basis. That includes the purchase price, plus things like those dealer premiums, maybe even storage fees. All that significantly impacts the final taxable amount.
And the main strategies the article suggests for actually managing those taxes, well, there's the holding period strategy, basically. Aim for holding over a year to target that lower 28% rate, and using tax loss harvesting across your whole portfolio to potentially offset some of those gains.
Mhm. And finally, if you go the IRA route, remember there are specific rules. Strict purity standards, 99.5% for gold, 99.9% for silver for any metals held inside. And critically, any distributions you take out later are taxed as ordinary income, not at those collectible capital gains rates.
Understanding these specific tax rules, it isn't just about checking boxes for the IRS. It seems absolutely vital for maximizing your potential net returns if you invest or are thinking about investing in physical precious metals. It really is a different tax animal, isn't it?
It definitely is. It requires paying attention to details that maybe aren't always top of mind with other assets you might hold.
Which I think brings us to a final thought for you to consider, sort of building on everything we've unpacked from the source in this deep dive. Given that gold and silver carry this unique collectible tax status, with those potentially higher long-term capital gains rates compared to many other investments, how might this specific tax treatment influence their strategic role, or maybe even their weighting, within your broader overall investment portfolio? Something to think about.